Picture this: a financial landscape where Asia's dynamism and potential are increasingly recognized and harnessed. At the forefront of this evolving economic narrative are two key players, Singapore and China. Singapore, a nation synonymous with financial acumen, has been progressively embedding itself into the fabric of China's expansive banking system. As we delve into this story, we discover a tale not just of investments and acquisitions, but of strategic partnerships shaping the future of international banking. Let's go back to the early 1990s, a pivotal era for Asia's economic landscape. This period marked the beginning of China's ascendancy as a global economic powerhouse, coinciding with Singapore's strategic shift towards regional financial integration. The backdrop was set by the burgeoning growth of China's middle class and the liberalization of its financial markets, which created fertile ground for foreign investments. Singapore, with its robust financial infrastructure and foresight, recognized this opportunity, setting the stage for a deep-rooted economic partnership. The journey began with DBS, Singapore's banking gem, marking its presence in China back in 1993. Fast forward to 2021, DBS's acquisition of a 13% stake in Shenzhen Rural Commercial Bank for over 5.29 billion Chinese yuan, which is 1.08 billion Singaporean dollar, represents more than just a financial transaction. It's a testament to Singapore's growing influence in China's banking sector. This move catapulted DBS to the largest shareholder position, empowering it with considerable sway over the bank. Delving into DBS's journey, we see a calculated expansion strategy. Its foray into China began modestly with a representative office, a move reflecting the cautious yet optimistic outlook prevalent in the early 1990s Asian banking sector. The acquisition of Shenzhen Rural Commercial Bank in 2021 wasn't a sudden leap, but a culmination of years of strategic positioning and market analysis. This decision was influenced by China's rapid urbanization and the rise of Shenzhen as a technology hub, which presented lucrative banking opportunities for DBS. UOB, another Singaporean titan, has been weaving its own story since 1984. Its acquisition spree includes a 15% stake in China's burgeoning ever-growing bank and an involvement in the Hengfeng Bank. OCBC, not to be outdone, made significant moves too. Its acquisition of Ningbo Commercial Bank and a subsequent $5 billion bid for Wing Hang Bank in 2014 facilitated its entry into both Hong Kong and Chinese markets. This strategic positioning amplifies OCBC's presence, especially through its transformed entity, OCBC Wing Hang. UOB's and OCBC's entries into China trace back to the era when Chinese banking reforms were gaining momentum post-WTO accession. UOB's 2008 acquisition of a stake in ever-growing bank coincided with China's post-2008 global financial crisis stimulus plan, which saw a surge in demand for banking services. OCBC's acquisition of Ningbo Commercial Bank and later Wing Hang Bank were strategic moves to tap into Eastern China's manufacturing and trade hubs and Hong Kong's status as a global financial center, respectively. Think of Temasek Holdings and GIC as key architects in this financial panorama. Temasek's portfolio boasts names like AIA Group Limited, Ping An Insurance Group, Industrial and Commercial Bank of China, ICBC, and China Construction Bank Corporation. Though holding a modest 2% in ICBC, Temasek's influence is far from negligible, given the bank's massive asset base. GIC, with its veiled investment strategies, adds another layer of depth to Singapore's financial engagements in China. Temasek's approach has been marked by a blend of prudence and foresight. The gradual decrease in its stake in ICBC from nearly 10% to 2% aligns with its broader strategy of portfolio diversification and risk management. This shift reflects the evolving nature of China's banking sector and the need for strategic flexibility in response to changing market dynamics. GIC's secretive nature and broad investment strategy have historically been geared towards long-term value creation. Its investments in China's economy, although less publicised, are understood to be diverse, spanning from real estate to technology sectors, reflecting a belief in China's long-term growth trajectory. Imagine the ripples created in a pond when a stone is cast. This is akin to the impact of these investments. For Singapore, it's not just about financial returns. It's about cementing its role as a significant player in the Asia-Pacific arena. The investments foster bilateral relations, opening avenues for trade and collaboration. For China, these partnerships bring confidence, aiding in the integration of its financial markets with global norms. The economic interplay between Singapore and China extends beyond banking. The investments by Singapore's banking giants have facilitated numerous bilateral trade agreements and joint ventures, further strengthening economic ties. This financial integration has been instrumental in fostering a robust trade relationship, with Singapore emerging as one of China's top trading partners in Southeast Asia. However, intertwined fortunes also mean shared risks. Economic downturns, policy shifts, or banking crises in China could impact Singaporean investments. Conversely, challenges faced by Singapore could affect its financial engagements in China. This interdependency necessitates careful navigation amid geopolitical tensions and global economic challenges. The interdependence between Singapore's and China's banking sectors is not without its challenges. The Asian financial crisis of 1997 to 1998 and the global financial crisis of 2008 are poignant reminders of the ripple effects of financial instability. These crises underscore the need for vigilant risk management and regulatory cooperation between the two nations to safeguard against future economic turbulences. As Singapore and China navigate the complex waters of global finance, they set a precedent for future economic collaborations. Their partnership, built on strategic investments and mutual trust, positions Asia as a burgeoning force in shaping global finance. With the world watching, these two Asian titans continue to forge a path that many might soon follow, crafting a narrative of economic integration and influence that speaks to the future of international banking. As we look towards the future, the evolving partnership between Singapore and China is poised to play a crucial role in shaping the contours of global finance. The steps taken by these nations in developing fintech, green financing, and sustainable investment initiatives are indicative of a shared vision for a more inclusive and resilient global financial system. So, as we close this chapter, let's reflect on the dynamic economic dance between Singapore and China. The financial dance between Singapore and China is more than a story of investments. It's a reflection of Asia's growing stature in the global economic arena. As these two nations continue to evolve and adapt to the ever-changing global economic landscape, their partnership stands as a beacon of strategic economic cooperation and a model for other nations to emulate in the quest for global financial integration and prosperity. Stay tuned. This is just the beginning of a fascinating financial saga. Thank you for watching, and don't forget to subscribe.